Thank you for the introduction. Good morning, everyone. Today, I'll be bringing you through the latest edition of our ETF Focus List. We launched our ETF Focus List in 2018 with the goal of spotlighting the best-in-class ETFs on equity, across equity and fixed income markets. With over 8,700 ETFs available on our platform, choosing the right one for your portfolio can be an overwhelming task, especially for those new to investing. And that is why we started the ETF Focus List to help investors sift through the vast number of options across various exchanges. Our ETF Focus List is updated on an annual basis to provide recommendations that are updated and relevant for investors. And for 2025, we have a total of 45 ETFs on the list. I believe most of you will have obtained a copy of this physical booklet that contains this year's focus list. But if you have not, you can head out to the hall later on to collect one from our booth. But not to worry, although there are limited copies of this physical booklet, you can still head on to our website by going to the FSMOne homepage. And under ETFs, you can select the ETF Focus List. This will bring you to our ETF Focus List page, where you can see 6 categories of recommended ETFs, namely core equity, fixed income, regional equity, single market equity, commodities, and tactical plays. And on the left of the screen, you see you'll be able to download the ETF booklet. But before diving deeper into this year's focus list, I would like to give a brief introduction into what ETFs are for the benefit of those new to investing. An exchange-traded fund, or ETF for short, is a basket of securities that tracks an underlying index, providing investors with access to a portfolio of holdings, be it stocks, bonds, or other asset classes such as commodities. You can think of ETF as a hybrid between a stock and a mutual fund. So like a stock, it is traded on exchanges during market hours, and like a fund, it holds multiple securities to provide investors with a diversified portfolio. And although ETFs are traditionally a passive instrument, active ETFs have become more popular in recent years. There are many different types of ETFs. Besides the commonly known equity ETFs, there are also ETFs that track the fixed income market, ETFs that track the prices of commodities such as gold, and currency ETFs that track the price of either a single currency like the Japanese yen or a basket of currencies. And as I mentioned, there are also actively managed ETFs, and unlike their passive peers, instead of tracking an index, active ETFs are managed by investment managers who seek to outperform a benchmark. So they're similar to mutual funds, but they provide the added flexibility of intraday trading. Next, we also have smart beta ETFs that combine elements of both active and passive investing. Like passive ETFs, they track an index, but instead of using a traditional market cap weighting, smart beta ETFs follow a rule-based strategy, and they weight securities based on specific factors. So to give you an example, if you were to invest in a growth-focused smart beta ETF, this growth-focused smart ETF, beta ETF, they would screen for companies with strong earnings growth or perhaps revenue momentum. And lastly, I'd like to talk about leverage and inverse ETFs. Leverage ETFs seek to amplify the daily returns of its underlying index, while inverse ETFs seek to deliver a return that is based on the inverse performance of its underlying index. And if you'd like to learn more about leverage and inverse ETFs, be sure to attend the sharing by my colleague Ron at about 12:10 later on. So now that you understand what ETFs are and the different types of ETFs, let me walk you through the selection methodology we use here at FSMOne. Starting with the quantitative factors, a key factor that investors should look at is expense ratio. What is expense ratio? It is the annual cost that investors have to pay in order to cover for the ETF's expenses, be it operating expenses or management fees. And needless to say, all else being equal, the lower the expense ratio, the higher the net returns. Besides expense ratio, another factor to consider would be liquidity. And this refers to how easy it is to sell or buy an ETF quickly without affecting its price. The higher the liquidity, the easier it is for investors to enter or exit their positions at favorable prices. And investors like yourself should look for ETFs with high average trading volume as well as narrower bid-ask spreads. And the third quantitative factor that investors should look at is tracking difference. And just a disclaimer, this is more relevant for passive ETFs rather than active ones. Tracking difference refers to the difference between an ETF's performance and the performance of its underlying index. And this difference in performance can arise because of different reasons. So for example, it can arise because of rebalancing costs, currency hedging costs, or securities lending. And since the primary objective of a passive ETF is to replicate the performance of its underlying index, we will want an ETF with a small tracking difference. Now moving on to the qualitative factors. When choosing an ETF, the underlying index has to be a good representation of the market and sector that the ETF intends to track. So for example, if you want to invest in Chinese tech stocks, as Wavren suggested just now, the Hang Seng Tech Index would be a more relevant index to look at than, say, just the Hang Seng Index. And another qualitative factor that investors should pay attention to is the structure of the ETF. An ETF can have either a physical or synthetic structure. A physical ETF tracks its benchmark by holding a sample or the entire underlying securities, while a synthetic ETF uses derivatives, such as swaps, to replicate the index's returns. And we generally prefer ETFs, physical ETFs, due to the minimal exposure to counterparty risks. However, if synthetic ETFs were to offer significant cost advantages and they are backed by multiple high-quality counterparties, we may view them as a more efficient alternative. Lastly, a factor that investors should consider is the listing location of the ETF. This is especially important for ETFs that pay out high dividends. So Irish domiciled ETFs listed on the London Stock Exchange, they benefit from lower withholding tax on dividends of 15% compared to their US listed counterparts at 30%. That said, you'll notice, if you've taken a look at our ETF Focus List, you'll notice that the majority of the ETFs on that list are listed on the US stock exchanges. Why is this the case? Although Irish domiciled ETFs may offer greater tax efficiency, they often have lower liquidity compared to their US-listed counterparts. And when choosing an ETF, it is important not to just look at a single factor, but to consider multiple factors. So if going through all of that, factors sounds like it's too confusing to you, or it sounds like a lot of work, not to worry, that is what the ETF Focus List is for. And we've made a total of 18 changes to this year's list, and I'll bring you through them in the coming slides. The first 3 changes that we made were the removal of US value, US banks, and US consumer staples. And these changes were driven by developments in the US this year since Donald Trump took office. As Wayron mentioned, the Trump administration's attempt to make America great again has wreaked havoc across the globe, threatening to reenact inflation, slow economic growth, and potentially weigh on corporate earnings as well. And in such uncertain times, we believe it is important for investors to be selective and focus on sectors that are resilient to macroeconomic headwinds. The digital economy and semiconductor sectors are 2 industries that we believe will thrive over the long term, regardless of tariffs. This is because the earnings of these companies in these industries are driven by structural trends such as AI and digitalization. And we believe that these factors and these drivers will continue to fuel sustained demand for the products and services of these companies. Moreover, leading players in these industries, they have robust balance sheets, and this gives them the financial strength to weather short-term declines in cash flow and earnings. So given our strong conviction in the long-term prospects of the tech sector, we have decided to remove the US value category. This is because, looking at this table here, you can see that value funds tend to be significantly underweight tech relative to the S&P 500, while they have greater exposure to sectors such as financials and consumer staples. Under our base case scenario of mild stagflation in the US, assuming elevated tariff persists, we expect the banking sector to come under pressure, both in terms of profitability as well as credit quality. Although banks do not earn revenue directly from physical goods, they remain exposed to the broader impact of an economic slowdown. And we anticipate weaker loan growth as consumer and business spending slows, along with a decline in investment banking and private equity activity because of reduced market confidence. Therefore, we have decided to remove US banks from the tactical place category. As for consumer staples, although consumer staples, they are traditionally defensive in nature, and people will buy them during periods of potential recessions, we believe that US consumer staples will be amongst the first to feel the heat of tariffs. As such, we have decided to remove the category to focus on ideas that we have greater conviction on. Last year, we removed China-related tactical plays due to our bearish outlook on the country. This was driven by the ongoing property crisis, heavy government intervention that dampened both growth as well as business confidence, and escalating geopolitical tensions with the US. However, since then, the landscape has shifted meaningfully. We have decided to add China Tech and China EVs back into the tactical plays category. China's economy is showing signs of recovery. It's being supported by sweeping stimulus measures aimed at stabilizing the property sector, as well as steering the country towards from an export-led economy to a consumption-led growth model. And at the same time, the emergence of DeepSeek's breakthrough AI model alongside the government's renewed support for the private enterprise has helped restore investor confidence in China's tech sector. And so in order to capitalize on this rebound in China Tech, we recommend the iShares Hang Seng Tech ETF, ticker symbol 3067. But for investors who prefer investing using their SRS, the Supplementary Retirement Scheme, can also consider the Lion OCBC Securities Hang Seng Tech ETF, ticker symbol HST. We have also reinstated our 2023 EV ETF recommendation, the Global X China Electric Vehicle and Battery ETF, ticker symbol 2845. And although Tesla may have led the initial wave of the EV revolution, but today you see that China stands as the world's largest EV market. And this is driven by factors such as strong government support, strong domestic demand, and a deeply integrated supply chain in the China's EV space. The next change I would like to highlight is the addition of Europe defense into the tactical plays category. Trump's America First agenda extends beyond trade, and he has also adopted a more transactional approach to transatlantic security. And this has threatened, and he has threatened, to withhold defense support to NATO allies that failed to increase their military spending. He has accused Europe of free riding on American defense and has demanded that NATO members raise their defense spending target from 2% to 5% of GDP. And this, coupled with the US's reduced support for Ukraine, has really prompted Europe to reconsider its dependence on the US. In March this year, the EU, the European Union, they launched the Rearm Europe plan to boost its military autonomy and respond to growing pressures from President Trump for Europe to take on more responsibility for their own defense. So this Rearm Europe plan is a 4-year, 800 billion euro fiscal stimulus aimed at boosting Europe defense spending. Europe defense companies tend to be key beneficiaries of this shift, and as the EU ramps up military spending, its dependence on US support to ramp up military spending to reduce its dependence on US support. We think that these firms are poised to benefit from not only accelerated procurement cycles, but also expanding order backlogs. And for investors who wish to capitalize on this structural pivot towards military autonomy in Europe, you can consider the Wisdom Tree Europe Defense UCITS ETF that's listed on the LSE, ticker symbol WDEF. Next, this year we have also decided to include a swap ETF into our focus list. And like I mentioned, although we have traditionally preferred physical ETFs to avoid the counterparty risk inherent in swap-based structures, we believe swap ETFs offer distinct advantages in the context of the Indian market. Physical India ETFs, for those who are not aware, are subject to capital gain tax when Indian stocks are sold, be it for portfolio rebalancing or when shares are redeemed by the authorized participants. And this capital gains tax can range from 12.5% if it's long-term capital gains tax, to all the way up to 20% if it's short-term capital gains tax. And since the amount of tax that you're going to pay depends on both the size of the gains, as well as how long you hold the ETF and the holdings of the ETF, investors of physical India ETFs they face an uncertain tax burden because they are not sure, how long the portfolio manager is going to hold the underlying securities. So because of this, they can, when Indian markets rally, it can lead to significant underperformance of the ETF relative to the index when Indian markets rally. So in order to avoid this uncertainty, investors can consider a swap-based structure instead, like the Xtrackers MSCI India Swap ETF, ticker symbol XCS5. And unlike physical ETF, XCS5 does not hold the underlying Indian securities. Instead, it enters into a swap agreements with counterparties that deliver the full return of the MSCI India index, including dividends, in exchange for a fixed swap fee. And this fee is transparent, you can see on the slide, and this provides a level of cost certainty that is not possible with physical India ETFs. Additionally, XCS5 also features a significantly lower expense ratio of just 0.19%, compared to 0.65% of our previously recommended ETF, the iShares MSCI India UCITS ETF, ticker symbol NDIA. And now I'm sure some of you may have some concerns over counterparty risk. You may be concerned that the counterparties to the swap agreements could default on their obligations. But we see that this is being mitigated through XCS5's engagement with multiple high-quality counterparties. This includes the likes of Barclays, BNP Paribas, SocGen, and Goldman Sachs. And you can also see here that the swaps are marked to market daily, and collateral is posted to fully offset any potential losses. However, we still understand that some investors may still be concerned, and if you're still uncomfortable with the counterparty risk, you can still continue to invest in NDIA, and it remains a solid alternative. Next, we're also changing our recommended ETFs for Latin America from iShares Latin America 40 ETF, ticker symbol ILF, to iShares MSCI EM Latin America UCITS ETF, ticker symbol DLTM. And this change is driven by, firstly, DLTM's lower expense ratio of 0.20% compared to ILF's 0.48%. And DLTM also has a slightly better tracking difference. At the same time, as an Irish domicile ETF, DLTM is only subject to 15% withholding tax on dividends, whereas ILF is subject to 30% withholding tax on dividends because it is domiciled in the US. Withholding tax savings is particularly important for Latin America ETFs, as they generally pay out dividends of roughly in the range of 5 to 6%. It is also worth noting that although ILF and DLTM, they track different indexes, they are highly similar in terms of both geography as well as sector allocations. Next, some other key changes. We have removed Brazil, Indonesia, Thailand, and Vietnam from the single market category due to limited investor interest. However, those who are still interested and would still like exposure to these markets, if you like exposure to Brazil, you can still consider investing in a regional ETF, such as the iShares MSCI EM Latin America UCITS ETF I mentioned. And if you would still like exposure to Indonesia and Thailand, you can consider the Global X FTSE Southeast Asia ETF, ticker symbol ASEA. Under core equity, the core equity category, we have also added S&P 500 ETF listed on the London Stock Exchange, ticker symbol SPYL, as an additional option for investors who would like to seek S&P 500 exposure on the LSE. Alongside our existing REIT recommendation for those who are familiar, so our existing REIT recommendation is the Nikko AM Straits Trading Asia ex-Japan REIT ETF, ticker symbol CFA, that's listed on the SGX. This year, we're also recommending the Lion Phillips S-REIT ETF, ticker symbol CLR, for investors who prefer more targeted exposure to Singapore REITs over a broader regional REITs. And like CFA, CLR is also eligible for SRS investing. Next, under regional equity, we have renamed Emerging Southeast Asia to Southeast Asia to offer a more inclusive representation of the region. Our previous recommendation for EM Southeast Asia, the Premier Dow Jones EM ASEAN Titans 100 ETF, ticker symbol 9810, does not have exposure to Singapore, which is one of our new Asian tigers. On top of that, 9810 continues to struggle with low liquidity, despite having been incepted for nearly 7 years now. And so for these reasons, we have decided to replace it with the Global X FTSE Southeast Asia ETF, ticker symbol ASEA. Although we acknowledge the fact that it has a higher expense ratio, we still prefer this ETF because of its higher liquidity. For fixed income, we have merged the US and global categories to reflect the fact that global fixed income funds, they tend to have significant US exposure, so we've decided to merge both US and global categories. And because of this, we have removed the SPDR Bloomberg US Aggregate Bond UCITS ETF, ticker symbol USAG, from our focus list, while retaining the iShares Core Global Aggregate Bond UCITS ETF, ticker symbol AGGG. So this ETF will be under the newly named Global Investment Grade category. And for the same reason, we have also renamed US High Yield to Global High Yield, with no change to our recommended ETF for the category. So those are all the changes we've made to this year's ETF Focus List, and I hope the list serves as a good starting point in helping you to craft a diversified, low-cost portfolio. As for the ETFs which have been removed or replaced from the list, not to worry, they still remain viable investment options, and they will also continue to remain available under our regular savings plan. Before I conclude, let me highlight some of the new features of our ETF page. And to navigate there, you can go to the ETF tabs of FSMOne homepage and select ETF homepage. On this page, you'll be able to see information of ETFs across different exchanges, including things such as the ETFs with the highest trading volume, ETFs with the most popular ETFs by regular savings plans, etc. We also have a heat map for people who are more visual learners or you prefer more visual things. You can have a quick overview of the ETF performance using this heat map. And lastly, there's also an exposure tool to help you quickly navigate to regions that you're interested in, and a stock exposure tool that help you to identify ETFs that hold a specific stock. And if you'd like to learn more about this tool, be sure to attend my colleague Ron's sharing later on. So that is all I have for today, and I hope you have learned something useful today. Thank you.